Chart patterns, flags, and pennants. Today, we'll be discussing bull and bear flags. They're both continuation patterns and will make it easy for you to identify them and easy to trade them. Definition. A flag is a technical charting pattern that looks like a flag on a flagpole and suggests a continuation of the current trend. Flags are areas of tight consolidation after a sharp movement in price and typically consist of between 5 and 20 price bars. The bottom of the flag should not be lower than the midpoint of the flagpole that preceded it. Likewise, pennant formations are usually treated like flag formations because they are very similar in appearance, tend to show up at the same place in existing trend, and have the same volume and measuring criteria. Breakdown. Flags and pennants are among the most reliable continuation patterns that traders use. The only difference between the two patterns is that a flag resembles a parallelogram, or rectangle, marked by two parallel trend lines that tend to slope against the prevailing trend. The pennant, however, is identified by two converging trend lines, and more horizontal, which resembles a small symmetrical triangle. The important thing to remember is that they are both characterized by diminishing trade volume, and though different, the measuring implications are the same for both patterns. This is what a flag looks like. It's made of two parts, the pole and the flag itself. This sharp rise here is the pole. The markets are rising sharply. Then we get a consolidation or pause. This pause comes in the form of a flag, which is a small retracement. This basically means that the bulls are ready to buy at a slightly lower price, because they believe the rally should keep on. There is more potential in the stock. We want this to break out and go up. We will not trade this short. This is a continuation pattern. Same with a downtrend. The prices are falling quite sharply. That would be the pole of our flag, and retracing a bit on the upside, giving us our flag. We can mark two trend lines moving upwards, and basically break of the trend would mean that the stock is breaking down and should continue falling. Why does a bull or bear flag happen? Let's say a stock beat the street. People were expecting $500 million of revenues, and they made $1 billion. It beat the expectations by a huge margin, and the prices will swiftly move up. When this happens, we will then get a pause, meaning the buyers drying up, evaluating the situation, and also the sellers waiting on the sidelines to see what happens. You get the profit brokers who have made a certain profit exiting, the day traders also exiting, and you get a small retracement. You're getting a lot of buying pressure in this move down. People are missing or adding up to the up move by buying on these certain points. It shows that the bulls are ready to buy at a slightly lower price, still after moving so high up. This pattern does pretty well when you put it off, especially on the major trades. Do try and trade this pattern on a slightly higher frame, like the 30-minute or 60-minute frame, because on the lower time frames it becomes a bit difficult to identify, because there are a lot of bars and every retracement looks like a flag. You should not get a lot of patterns on a chart that just mean it won't work. You don't have an edge. Trading considerations. The pause period is often followed by another sharp rise. This is where the trading opportunity comes in. Once the flagpole and a flag or pennant have formed, traders watch for the price to break out above the upper flag or pennant trend line. When this occurs, enter a long trade. The above pattern is bullish because the pattern started with a sharp rally. There are also bearish patterns, where the price drops sharply, then forms a flag or pennant. With this pattern, watch for the price to break below the flag or pennant. If a short trade is taken on the downside breakout, place a stop loss above the high of the flag or pennant, not the flagpole. If a long trade is initiated on an upside breakout, place a stop loss below the low of the flag or pennant, not the flagpole. Price target. The concept behind the flag and pennant patterns is that the momentum seen during the flagpole phase could continue once the pattern completes. Therefore, measure the size of the flagpole and add that length to the bottom of the flag or pennant for bullish patterns. For bearish patterns, subtract the length of the flagpole from the top of the flag or pennant. Conclusion. Flags and pennants occur in both uptrends and downtrends, focusing on trading upside breakouts from bullish patterns during uptrends, while a downside breakout might indicate the price could move lower for a time. Going short during an uptrend is a less reliable trade. Similarly, if an asset is trending lower, focus on trading downside breakouts from bearish patterns. Since flagpoles can be quite large and the size of the flag or pennant quite small, these types of patterns produce. The reward or profit target is based on the strong movement of the flagpole. The stop loss, on the other hand, is based on the small area that forms the flag or pennant. Reward potential in these trades often outweighs risk by a factor of 3 or more. Stay with us for the next lesson. We'll fully explain how to trade flags and pennants.